This week in economics on the 6th of March and some on the 5th of March. It's being recorded on the 5th, nonetheless, 2016. And numbers man here. We have the jobs report. We have some PMIs from the market people. And we'll look at a new move in the Congress on transparency in the Fed. Representative Waters of Los Angeles and one other representative have filed there to have the Congressional, I believe it's Congressional Research Center. Anyway, we'll get to that in a minute. But firstly here, the numbers released on the 4th of August from, 4th of August, the 4th of March from the Bureau of Labor Statistics in the Labor Department. This is the employment situation in February. Non-farm payroll employment increased by 242,000 in February. The unemployment rate was unchanged at 4.9. A little unbelievable there. A few years ago, right after the Depression, people were thinking that quote-unquote full employment would be at basically 5.5%. At one time, in the 60s and early 70s, we called full employment at about 2.5%, and then it was 3%, then it was 4.5%, and now 4.9%. In some areas, it's less. The household survey in February, the unemployment rate at 4.9%, and the number of unemployed persons at 7.8 million. It was unchanged. Over the year, the unemployment rate and the number of unemployed persons were down 0.6%, and that's 831,000 there. Among major work groups, unemployment rates for adult men at 4.5%, adult women at the same, and teenagers at 15.6%, which is a good ratio for teenagers, a good percentage, I should say. For Europeans, 4.3%. African Americans, 8.8%. That's down some. Asians, and they're very numbers, I should say, various numbers of people under that broad category. 3.8%, and Latinos, 5.4%. Showed little or no change in February. The number of long-term unemployed, those unemployed for, and they put this at 27 weeks or more, were essentially unchanged at 2.2 million in February, and showed little movement since June. In February, these people accounted for 27.7%. We'll call that 28%, a little rounding off we used to do, and nonetheless, anyway. The employment population ratio at 59.8% over the month, and the participation rate 62.9%. Basically, we are moving on 63%. Both measurements have increased by 0.5% since September, which is a good report. The number of persons employed part-time for economic reasons, voluntary part-time workers also is unchanged at 6 million. These individuals that would have preferred full-time work, they couldn't find it. In February, 1.8 million persons were marginally attached to the workforce. That's down by 356,000 from 2015. Among the marginally attached, there were 599,000 discouraged workers. That's roughly almost 600,000. In February, that's down 133,000 from a year earlier. Now on to the establishment survey. The Department of Labor has two surveys, the Household and Establishment Survey. The non-farm payroll employment increased 242,000 in February. Job growth occurred in healthcare, social assistance, retail, trade, food, services, etc. Healthcare and social assistance added 57,000 jobs in February. Healthcare employment increased by 38,000 over the month, with job gains in ambulatory healthcare services, 24,000, medical centers, 11,000 over the past 12 months. Medical centers have added 181,000 jobs in February. Employment rose by 19,000 in social assistance, mostly individual and family services. More social workers, etc. added. Retail trade continued to add jobs in February. A little unusual because you have your holiday season, and generally speaking, there's a spike and then a downgrading. Nonetheless, 55,000 were added. Employment rose in food and beverages. We've seen more eating and drinking establishments around than ever. 15,000 of general merchandising stores, 13,000. Retail trade added 339,000 jobs or so over the past 12 months. Food and service and drinking places, 40,000 in February alone. Over the year, employment is in the industry has grown 359,000. Private education services rose by 28,000. A lot of competition going on there. February after edging down 20,000 in January. Construction employment continued to trend up, 19,000 in February, very unusual for the winter months in much of the U.S., with a gain of 14,000. Excuse me. In residential specialty trade contractors, employment in construction was up 253,000 over a 12-month period. Employment in mining declined, as in the oil industry, etc., 19,000 jobs and 16,000. Coal mining down 2,000 jobs since the peak in September of 2014. Mining has shed 171,000 jobs, with more than three-fourths of losses in support activity for mining. Very unusual there. But that industry has been hard hit by a number of factors over a few years. In major industries, including manufacturing, wholesale trade, transportation, warehousing, financial services, etc., the average work week for all workers on private non-farm payrolls, we still have that. That's a leftover from the old days. 0.2 an hour to 34.4 hours in February. Manufacturing week was unchanged at 40.8. Little building over to 0.8 there. Factory overtime at 3.3 hours for the third month in a row. The average work week for production, non-supervisory workers, edged down 0.1 an hour to 33.7 hours. In February, the average hourly earning for all workers declined 3 cents to $25.35. We were talking about this, the campaign for $15 an hour. Now, the average now, and again, this is the average, is at $25.35, an increase of 12 cents in January. A lot of contracts become active in January of the new year, depending on the company's fiscal year. The average hour earning has risen 2.2% over the year. A lot of talk in this presidential year of income inequality. In February, the average hourly earnings, private sector production, non-supervised, unchanged at $21.32. The change in total non-farm payroll employment from December was revised from 262,000 to 271,000. That's really not unusual to get these revisions. Employment gains in December and January combined were 30,000, more than previously reported. Over the past 3 months, job gains averaged 228,000. To pull the slack out of the economy, you need about 100,000 more, actually about 350,000, but these are different times. There's obviously no doubt about that. Let's look at the market PMIs now. And let me find it. This is from the Market People. This is the U.S. Service PMI. And the caption here is, this is the final data composite one, service activity falls for the first time since October of 2013. The key points, service sector performance for almost 2.5 years, new business employment growth sustained in February. We just went over that. Business conditions slipped to its lowest level since August of 2010. February data points to a fractional reduction in the U.S. service activity, which ended a 27-month period of sustained growth. At the same time, new business activity volume expanded at a slower rate since January of 2015, and service providers were the least optimistic about growth prospects for 5.5 years. Survey respondents noted that heightened uncertainty about wider economic activity outlook, reluctance among clients to commit to new projects were factors. Adjusted for seasonal influences, the final market U.S. service business activity index registered 49.7 in February. That's down from 53.2 in January and below the neutral 50 status. In almost 2.5 years, as a result of the latest reading indicates the weak service sector performance, the government shutdown disruption in October 2013. The seasonally adjusted final market U.S. composite PMI output index at 50 in February, thereby signaled that the private sector output was unchanged over the month. Moreover, the index was down from 53 in January and the weakest since October of 2013. While temporary disruptions related to heavy snowfall on the East Coast was a factor in the service index, anecdotal evidence from the survey respondents also just suggests that a softer new business growth and concerns about underlying economic outlook have placed downward pressure on business activity. Growth of incoming new work has now erased for for 3 consecutive months, with the least upturn the weakest since 2015. After service providers pointed to generally supportive economic conditions, some report more cautious spending patterns. February data, meanwhile, indicates a further drop in unfinished work, with the backlog depletion the fastest in almost 2 years. Despite a drop in business activity and a softer expansion of incoming new work, the latest survey highlights that job creation was sustained at a solid pace in the service economy. The rate of unemployment growth eased since January, but was still slightly faster than the long-running survey average. Overall input inflation remained moderate in February, while survey respondents widely linked to the influence of lower fuel prices, petrol. Meanwhile, price changes by service providers decreased for the first time in 5 months, but only a fractional pace. Looking ahead, service providers' optimism about the year-ahead business outlook dropped to its weakest since August of 2010. Getting a little ahead of myself. From Dr. Chris Williams, he is the Williamson. He's a chief economist there at Market. Business activity stagnation in February as malaise spread from manufacturing sector to service sector. The market PMIs are signaling a stagnation of the economy in February, suggesting growth has deteriorated further since last year. Price pressures are warning again in line with fluttering demand. Average price charged for goods and services are dropping once again, down for the first time in 5 months as firms compete to win new business. Worse may be to come, as inflows of new business has slowed sharply, causing backlogs of work across both sectors to fall at a faster rate since 2008-2009 financial crisis, which we call a depression. My words, not Dr. Williamson's. Nonetheless, such a weak demand suggested business activity and price discounting look set to continue. However, perhaps the brightest warning light is the downturn in business optimism to a joint lowest record by the survey, suggesting firms are bracing themselves for trouble ahead. This is not a good report. The only positive note in the PMI report is that the sustained robust rate of job creation. That basically means that in an economy that is not, as they say, expanding at the rate one would think, businesses are still obtaining new workers, at least at this point in the scenario. Let's look at another PMI here. We'll go to Germany. This is a construction PMI. Wait just a second here. We'll do the Eurozone composite PMI. That will. This is the includes the Eurozone service PMI. So we'll get all of everything here together. This was collected from the 12th to 24th of February, released on March the 3rd. February saw a broad-based slowdown of Eurozone private sector economy. Rates of output expansion eased across Germany, Italy, Spain, Ireland, while France fell back into contraction for the first time in 13 months. Price pressures also remained on the downside, while modest reductions registered for both output changes and input costs. The final market Eurozone PMI composite output index fell to 53 in February. It's the lowest reading since January of last year, above the earlier flash of 52.7. The rate of output growth slowed in both manufacturing 12-month low and service sector 13-month low. The level of incoming new business also rose at a weaker pace in February. It's least marked in a year. Spain, Ireland reported slower increases, and France saw a contraction. But demand growth ticked up higher in Germany and Italy. There's also signs of pressure on capacity easing at Eurozone companies as backlog work rose only negligibly. Employment increased for the 16th consecutive month in February, with job creation signal at both manufacturing and service providers, same as in the U.S. However, the combined rate of increase eased to a 5-month low, reflecting slower growth trends in output and new business. Staffing levels were risen across the big four Eurozone economies in February. Modest increases in Germany, Italy, and Spain saw a faster pace of increase. Also ticked higher in France, but remained marginal and weaker amongst the big four. Deflationary pressures intensified in February. Average price change charged for goods and services, but declined at a faster rate as companies competed to win new business, the same as in North America. Selling prices reductions were seen in France, Spain, Italy, with decrease especially sharp in France and Germany and Ireland. Both registered higher output prices as increased at service providers offset reductions at manufacturers. Meanwhile, an average input cost fell for the second month running to a slightly greater extent than in January. Manufacturers reported the steepest drop in purchase prices in over 6.5 years, in contrast to service providers provided at 53 53.3 in February, down 53.6 in January. Eurozone service business activity index fell to its lowest since January 2015. Three of the big four national service economies, that's Germany, Italy, and Spain, saw a growth of business activity while France fell back into contraction. The slowdown has mainly reflected a weak rate of improvement in new business received. Slower growth of new work, meanwhile, filtered through to the labor market and business confidence. Job creation in the Eurozone service providers slowed to a 4-month low, but remained stronger than the average for the current 16-month sequel of growth. All nations are covered by the survey reported higher employment. France reported the weakest increase in payroll numbers, Ireland the fastest, although both saw job acceleration since January. Germany, Italy, and Spain also slower expansions in staffing levels than a month earlier. Business optimism dropped to a 3-month low. In February, confidence levels were the lowest in each of the big four Euro area nations and also in Ireland. However, the overall degree of positive sentiment was broadly in line with the long-term survey average. Input price inflation faced by Eurozone service firms was little changed from moderate rates seen in January, well below the long-run series average. Falling fuel prices again helped to keep cost pressure low. However, the average output changes declined for the 5th month in a row. Only Germany and Ireland reported increase in selling prices. Now from Dr. Williamson here, the final Eurozone PMI came in slightly ahead of the early month flash, but still showed the pace of growth waning for the second consecutive month in February, the slowest for just over a year. The survey data raises the prospect of of economic deterioration further from the already meager pace seen last year when GMP rose only 0.3%. Germany and Italy both reported the smallest expansion for 5 months, while Spain recorded the worst growth for 14 months. It was France, however, that remained the weakest link, seeing business activity fall for the first time in over 1 year. While Germany, Italy, and Spain are all seeing PMI survey signal modest GMP growth in the first quarter so far, France appears to be at risk of stagnation. Slowdowns in growth of business activity accomplished by similar easing in the pace of job creation and the steepest fall in price changes for a year suggests that the region's recovery is losing momentum. The broad-based disappointment ups and the odds of the ECU, that's the European Central Bank, acting aggressively to avoid a downturn. Now let me check into these to see if what else we can pull out of here. Pretty much has covered most things here. We'll go to China. This is a general service PMI. We don't need to get it in Chinese, we will be in trouble here. This is China's general service PMI summary here. This is the Chinese service sector expanded a weak pace in February. This is from Kazakh people here, I think that's pronounced that way. Total was at 49.4. The composite index was down from 50.1 in January, below the neutral 50. The same thing basically here. The latest data indicates a softening of growth momentum across China's service sector, with business activity expanding only at a modest pace. Moreover, the Kazan, that's CAIXIN, General Services Business Activity Index reading of 51.2 was down from January's 6-month high of 52.4, pointing to a rate of growth that was much slower than the historic series average. Manufacturing companies, meanwhile, saw a further contraction of output in February, the rate of reduction quickening to the steepest since September 2015. New business growth also showed across the service sector in February after a solid rise the start of the year. Moreover, the latest increase in new orders was weaker than the long-run trend and only modest, with panelists commenting on relatively subdued client demand. New orders continue to decline at manufacturing companies in a slightly quicker rate than the start of 2016. Moreover, new business was broadly unchanged at the composite level in February, following a marginal rise in January. Slower increases in both activity and new orders contributed to weak expansion of the service sector. Staffing numbers. Companies report that higher staffing numbers generally mention hiring new employees in line with new order growth. Job shedding, meanwhile, intensified across the manufacturing sector in February, with the latest decline in the workforce numbers the sharpest since January of 2009 in the worldwide depression. Manufacturing service providers both recorded lower levels of outstanding business in February. This signaled a second successive month decline in backlog at service companies. Meanwhile, the first time that the level of work in hand had fallen at manufacturers since April of 2015. Moreover, the rate of depletion, only slightly across both sectors. Input costs continued upwards trend across the service sector in February. The rate of inflation was modest. It goes for basically all countries here surveyed. Despite quickening to a 4-month high, manufacturing firms saw a further fall in input pricing during February. That said, the rate of deflation was at the level least marked since August of 2014. Consequently, input costs rose slightly in the first time in a year and a half. Substantial cost inflation at service providers led to an increase in price charged since last August, while goods producers continued to discount their selling prices in February at the composite level. Output prices fell at a marginal pace and was the slowest in 9 months. In spite of soft growth, service providers signaled improved confidence toward the one-year business outlook in February. Moreover, levels of positive sentiments was the strongest in several months. This is a little bit different here from some of the others. And now the comment here, this is the chief economist, Dr. Hugh Fong. The growth index for February was at 51.2, down 1.2 point from January. It remains above the 50. Here, overall, the service sector has outperformed manufacturing industries and reflects continual improvement in the economic structure while implementing measures to stabilize economic growth. The government needs to push forward reforms on the supply side in the service sector to release its potential. And that is all we have on this one. And let me see, where are we going here? It's all the PMIs. Well, we'll do the Russian PMI, and this will be the last one. And okay, we'll kind of skate over it. This is the Purchase Managing Index. Here, Russian service providers report a slight increase in their business activity levels in February, driven by expansion in new orders. However, a rise in new projects could not prevent a further sharp deterioration outstanding business in the sector. Meanwhile, job cuts were evident while price pressure continued to persist, posting a 50.9. That's up from 47.1 in January. The seasonally adjusted market Russian service business activity index to signal a return to growth territory for the Russian service sector during February. However, the latest increase ended a 4-month sequel of contraction. The Russian composite output index also returned to expansion territory during February for the first time in 3 months. However, at 50.9, up from January's 48.4. The latest upturn was relatively weak. A higher level of new business was reported by the Russian service sector during February, the first increase in 5 months. However, the pace of growth was relatively weak. Anecdotal evidence suggests that the expansion reflected the introduction of new products across the sector. Meanwhile, a slight rise in volume of new orders reported by manufacturers this month. Outstanding business volume deteriorated further at both the Russian service providers and manufacturers in February, highlighting ongoing spare capacity in the economy. The rate of decline in the service sector was marked and accelerated to the quickest in 4 months. A lower volume of incomplete work has been reported in the past 63 survey periods by service providers. Faced with lower levels of incomplete work, Russian service sector firms continue to shed jobs. Moreover, workplace numbers have declined in each survey in the past 2 years. They've been in a recession, teetering on a depression. A slide in workplace numbers was also evident in the manufacturing sector, continuing a trend that has been observed since July of 2013. The latest survey data highlights a further sharp increase in average cost burdens, extending a trend that has so far defined a series of input prices rose at a solid pace despite easing to a 3-month low. Higher prices for inputs led the Russian service sector to raise their average tariff during February. The rate of inflation quickened to a 5-month high. Price pressures persist in the Russian manufacturing sector during February. A severe increase in input prices contributed to an accelerated pace of output inflation. And February's data signal confidence amongst service sector firms in Russia towards further output growth. However, levels of positive sentiment was relatively weak. The comment here by Samuel Agas is an economist at Market. February was the most prosperous for Russian service providers after headline of PMI signal a return to expansion territory for the sector. New business levels rose for the first time in 4 months after depreciation of the ruble increased international appetite for Russian services. This drove a marginal rise in output. Welcome news after firms endured a decline in activity over the previous 4 months. However, there are still plenty of headwinds for the sector to overcome until consistent economic growth can be achieved. Workforce numbers are sliding, and companies continue to report deterioration outstanding business levels as to drive up costs and pace pressure on marginal activities. So we look at the Eurozone. Basically, Eurozone is going downward. The Russian economy, there's a little, I guess what you'd call anecdotally, breathing space provided there. A little different type of situation. Let us go to the BBC in South Africa. They have a new tax, proposing one on what they call fizzy. This is sugar-based drinks. There, South Africa joined the battle against sugar, becoming the first African country to plan a tax on soft drinks. And Mexico has one, an average of less than, let's see, 0.5 C for a can of drinks, affordable for the vast majority, have become a regular feature of the weekly diet. So there's a lot of orange Fasta, and looking at the sugar rate, the average sugar intake by teaspoons. South Africa is at 17, Mexico is at 35, and the U.S. is at 40, and Egypt is at 21. So the battle for sugar is on. South Africans drink a lot of sugar drinks, as opposed to aspartame and whatever else corn or syrup that you have in the U.S. is much more sugar-induced. So somehow we landed on sugar. Let's move to the rest of the business diet here, so to speak, to China. Last year, China's growth was at 7%. The economy actually grew at 6.9%, the lowest expansion in 25 years. Mr. Liu said China was targeting consumer inflation at about 3%, unemployment at 4.5%. Meanwhile, the Xinhua agency reported the country's defense spending will rise by 7.6%, much below most of the Western countries. And the stock market slump index losing more than 30% of their value since 2015. This is some of the economic data here added to concern the U.S. rated Moody's downgraded its outlook for China from stable to negative. Of course, a lot of social tension would be involved here. President Xi has been touring the nation, and the National Congress has been in session there. So we'll have more of that on the other presentation. Let me get to let's see. Trying to get some of this data. We usually go to their own data, more stimulus in the cards for China. And let me just check here. We are... they don't have it up here, but usually I'd have to go back to research notes here to find lowest expansion in 25 years. This is the BBC, incidentally, we're looking at now, and we're not finding actually what we want to find here. The International Monetary Fund to grow from 6.3% this year to 6% in 2017. If you look at most of the Eurozone and most of these countries, they are not growing at very large rates. So in other words, a new era has been entered, not only in the U.S. but across the Eurozone and China, exception of being India, that has a greater acceleration in growth. And we're just seeing these patterns over the market spectrum, the worldwide market spectrum. And GDP, we talked a little about the National Congress They are in session, and the Chinese economy has been a top agenda. This is a 10-day annual session of the National People's Congress. This has about 3,000 delegates from each region of China. The country is expected to lay off 1.8 million workers, 15% of the workforce in coal and steel. So in other words, we talked a little bit about mining in the U.S. losing workers. That is a worldwide phenomenon because of gluts that are out there. We'll have to return with some Chinese figures. We don't have them now. This is the national Chinese figures, but so we'll have to sort of, as they say, move in a little different direction here. And we'll go now to the markets. These are Friday unless otherwise noted. And we'll finally get there. The BBC Global 30, the change there was 28.68. Was up. The FTSE, all shares, 37.44. In Amsterdam, where were they? At 4.04 on Friday. In Frankfurt, the DAX at 72.25. In Paris, they were at 40.45. In Brussels, 2.01 or not 1. In Madrid, 44.60. In Zurich, 31.73. In Moscow on Friday also 19.60. In Johannesburg they were down 294.82. In Bombay 39.49. In Karachi 204.0 or not 5. In Lahore they were in the negative at 45.11. In Colombo also in the negative 3.29 on Friday. And Wednesday in Tehran 49.91. In Sydney on Friday 8.90. The Nikkei was at 54.62. In Hong Kong, the Hang Seng at 234.94. In Shanghai 14.39. In New York they were, 62.87. The Nasdaq at 9.60. The Merck, which is out in the Midwest city of Chicago, the commodities market, at 6.59. In Zimbabwe, 1891.48. And finally in Mexico at 106.80. A quick look at commodities. Brent crude on Friday up $1.82 at $38.89. The spot was up $1.48 at 38.36. And West Texas Intermediate was also up $1.64 at $36.21. T-Bone Pickett is jumping for joy there. He was $15 a barrel oil. They're trying to inch to about $40 a barrel, it appears. And the all-out bang for the buck, so to speak, as they are in dollars, would be around $50. That's about 50% less than they were over a year past, but there's still a very big glut. And we remind people that this is a speculative market, and it can go up and it can go down based on emotion, period. Nonetheless, gold. We do have Dubai gold futures up to $4.80 at $1,263.90. The Forex was up $29.55. Why, we have no idea, at $1,271.50. Silver was even up 46 cents at $15.43. So Euronext Light futures, cocoa was up $26. And let's see, corn futures were down $1.25. Robusta coffee was down $6. And white sugar, I don't even know why we give this one, was up $4.60. The Bloomberg Commodity Index, 78.38. That was where they were. The Bloomberg Commodities Index. We give that one basically there. I have to look a little bit more into the Bloomberg Commodities Index to find out precisely where we are here with it. Some obvious changes involved here, but anyway, we'll give the dynamics of it later. Let me get the last item here. This was from the Reuters agency, providing we can find it very, very quickly. Oh, here we go. This is the U.S. watchdog to probe Fed's lax oversight of Wall Street. U.S. watchdog agency is prepared to investigate whether the Federal Reserve and other regulators were too soft on the banks that they were meant to police. And this is by two lawmakers, Congresswoman Waters of the Financial Services Committee. She's out of Los Angeles, and Al Green, he's out of Houston, of the Subcommittee on Oversight and Investigations, asked the Government Accountability Office on October the 8th to launch a probe of regulatory capture and to focus on the New York Fed, according to a letter obtained by Reuters. So it's been in the works for a while here. The probe, which has not previously been reported, made public, is the first by an outside agency into to the perception that government regulators are captured by and too differential to bank services, particularly the New York Fed. Such perceptions have dogged the central bank since it's failed to head off the 2007-2009 depression. The Fed's biggest critics have since been Republicans looking to curb its independent policy. But this is a little bit different here. The agency will conduct an assessment across the financial regulators, and the Federal Reserve will be one institution, he said. And this was from Lawrence Evans, director of the GAO, Financial Markets and Community Investment Agency. So this is a Government Accountability Office. The GAO, the New York Fed, which acts as the central bank's eye and ears of Wall Street, has come under severe fire for a series of oversights and perceived conflicts of interest, no doubt about that. In one instance, a former New York Fed examiner launched a wrongful termination lawsuit and released some secretly recorded tapes that portrayed her colleagues as being soft on Goldman Sachs. This prompted a hearing in which Senator Warren warned the New York Fed President Dooley to fix his institution's cultural problem. Of course, the New York Fed had nothing to say about this, no comment. In the letter, Waters and Green said they were particularly concerned about reports of a revolving door between the New York Fed and the banks, a reluctance to challenge them. The lawmakers wanted GAO to use the New York Fed's actions between 2008-2015 as a case study for broader investigation. Congress and financial regulators must fully understand the regulatory gaps and weaknesses that exist, they wrote, requiring analysis of 6 areas, including independent regulators, their ability to escalate concerns and incentives they face to take jobs at banks they supervise. This has been a big, big problem. A year ago, Dr. Yellen said the Fed takes the risks of regulatory capture very seriously and works very hard to prevent it. Republicans have frequently complained about it, but there's a different type of complaint. Democrats have grown more critical since the Fed raised interest rates in December. The testimony of Chair Yellen, Waters usually a staunch defender of the Fed, raised concerns about this $7 billion interest the central bank paid to certain banks last year to help tighten monetary policy. The GAO, which reports to Congress, also evaluates the integrity of the Fed's operation, including supervisory of some of the world's biggest banks. The agency is now determining objectives in selecting a term, Evans said, and looking to explore issues in the requests in a balanced, objective, fact-finding, non-partisan, non-ideological way. A big task at best. Once the probe is completed, GAO will report to lawmakers and give them 30 days before it publishes the findings. So now the GMO is there, and they'll find a basis at which to argue these various tenets. And we have a special feature. We were going to put it here. We ran way over here, but nonetheless, we were going to put it on this program. But we'll have a special program. And on some of these channels, you will hear the complete report that we now have. On other channels, it will be a bit edited, but nonetheless, it'll be there. There was an interview with Warren Buffett, the chief operating officer of Berkshire Hathaway, on the economy and what Berkshire is doing, and we'll have that in a special report. Have a good weekend, everyone. For those in business, next week, a productive one for the consumer. Keep your eye on the prize and on the financial news of the day. Good day.